At 2:17 a.m. Washington time, while most of America was asleep, a secure line lit up inside a quiet government office. On the other side of the world, in Beijing, it was already afternoon. Two senior officials picked up that call. No cameras, no press release, no translators in the room except the ones sworn to secrecy. And within minutes, words spoken on that line would quietly move nearly $12 trillion across global markets. Stocks shifted, bonds jumped, currencies trembled, and almost no one knew why. If you think markets only move because of public speeches and breaking news headlines, this story will change the way you see global power. Because sometimes the biggest financial earthquakes, begin on Wall Street or in Beijing's trading floors. They begin with a single phone call. And today, on the Monetary Shift, we're going deep into the secret call between Washington and Beijing that reshaped global money flow overnight. Before we break it all down, if you follow global finance, power shifts, and the hidden forces that move trillions, make sure you like this video and subscribe to the Monetary Shift. It helps the channel grow and keeps you ahead of the next big financial story before it hits the headlines. To understand what happened, you need to understand the pressure building before that call. For months, tensions between the United States and China were rising again. Trade restrictions were tightening. Technology exports were under review. Military activity in the Pacific was increasing. Investors were nervous, but not panicked. Yet, the United States economy was slowing under the weight of high interest rates. The Federal Reserve had been aggressively raising rates to fight inflation. That made the dollar stronger, but it also made global borrowing more expensive. Countries holding dollar debt were feeling squeezed. At the same time, China was facing its own problems. Growth was weaker than expected. The property sector was unstable. Youth unemployment numbers were quietly rising, and foreign investors were pulling money out of Chinese markets at the fastest pace in years. The leadership in Beijing knew something had to change. Here's where it gets interesting. China holds over $800 billion in U.S. Treasury bonds. That makes it one of the largest foreign holders of American debt. Those bonds are not just investments. They are leverage. They are influence. They are financial power. Now imagine this scenario. If China suddenly sold a large portion of those treasuries, U.S. bond yields could spike. Borrowing costs in America could rise sharply. Markets could panic. The dollar could swing violently. Even rumors of such a move can shake global finance. On the other side, if the United States imposed harsher financial sanctions or restricted access to dollar clearing systems, China's trade engine could slow dramatically. Both sides had pressure points. Both sides knew it. That secret call reportedly centered around three things: currency stability, debt markets, and a potential shift in global payment systems. Officials in Washington were concerned about unusual Treasury trading volumes. There were signs that large blocks of U.S. debt were being repositioned through intermediaries, not dumped publicly, but quietly shifted. At the same time, Beijing was worried about capital flight. Wealthy Chinese investors were moving money offshore. If the yuan weakened too quickly, it could trigger even more outflows. Stability was becoming fragile. During that call, sources say the tone was firm but pragmatic. Neither side wanted a financial shock. Both economies were too interconnected. American pension funds invest in Chinese-linked supply chains. Chinese factories depend on U.S. consumers. A financial war would hurt both. One key moment in the conversation reportedly involved a reassurance. Washington signaled that it was not planning immediate financial sanctions targeting China's core banking system. In return, Beijing signaled that it had no intention of rapidly liquidating large portions of its U.S. Treasury holdings. That mutual signal alone calmed markets, even before the public knew about it, because large institutional investors monitor flows. They watch bond auctions. They track currency swaps. Within hours of the call, Treasury yields stabilized. The dollar stopped climbing. Asian markets opened stronger than expected. Analysts later estimated that nearly $12 trillion in global assets, from equities to sovereign bonds to derivatives, were directly or indirectly affected by the shift in expectations that followed. Not because money physically moved all at once, but because risk perception changed. And when risk changes, trillions reprice instantly. Think about that. A change in tone, a pause in escalation, a private understanding, and $12 trillion in valuation pressure adjusted. That's the scale we're talking about. But there was something deeper beneath that call. It wasn't just about calming markets, it was about power. For decades, the US dollar has been the backbone of global trade. Oil is priced in dollars, commodities are settled in dollars, international loans are issued in dollars. China, however, has been slowly building alternatives, expanding yuan-based trade agreements, promoting cross-border payment systems outside traditional Western networks, encouraging energy deals settled in local currencies. Not to destroy the dollar overnight, but to reduce dependency. Washington understands this strategy, and Beijing understands America's dominance in global finance. That call was not just crisis management, it was negotiation over the future architecture of money itself. Behind closed doors, discussions likely touched on digital currencies as well. The United States is studying central bank digital currency models. China is already piloting its digital yuan in multiple cities. Whoever sets standards early could shape global finance for decades. What makes this story powerful is not secrecy alone. It's the realization that public speeches often come after private agreements. By the time headlines appear, positioning has already happened. Institutional capital has already moved. Some insiders believe that part of the understanding involved a coordinated slowdown in aggressive economic signaling, fewer surprise announcements, more predictable policy language. That predictability reduces volatility, and reduced volatility protects both economies. After the call, something subtle changed. The narrative shifted from financial decoupling to managed competition. That phrase matters. Managed competition suggests rivalry without collapse, tension without breakdown. Markets responded accordingly. Volatility indexes dipped. Emerging market currencies recovered slightly. Commodity prices steadied. None of this was dramatic enough to trend on social media, but large funds noticed, and they adjusted positions worth billions. Here's the part most people miss. In modern finance, expectations are more powerful than actions. If investors believe that Washington and Beijing will avoid extreme measures, they price in stability. If they believe escalation is coming, they price in fear. That secret call reshaped belief, and belief reshapes capital flows. Now ask yourself this: what happens next time tensions rise? Will there be another quiet call? Another recalibration behind the scenes? Probably, because neither side can afford uncontrolled financial warfare. The global system is too intertwined. At the same time, long-term shifts are still happening. Supply chains are diversifying. Countries are exploring non-dollar settlements. Defense budgets are rising. Technology restrictions are tightening. Cooperation in the short term does not erase competition in the long term. For viewers of the monetary shift, the real lesson is this: watch actions, not headlines. Watch bond yields. Watch currency swaps. Watch cross-border settlement data. That's where the real story lives. The $12 trillion move was not a visible explosion. It was a silent adjustment, like tectonic plates sliding beneath the surface. No loud crash, just a new alignment. And here's something even more interesting. The existence of that call itself sends a message to the world. It tells Europe, Asia, and emerging markets that despite rivalry, the two largest economies still coordinate when stability is at risk. That coordination reinforces their central role in the global system. Some critics argue this proves how fragile the system has become. Others say it shows how mature global financial management has evolved. The truth is probably somewhere in between. But one fact remains clear. In a world where a single private conversation can influence trillions, transparency is limited and power is concentrated. Understanding that reality gives you an edge as an investor and as a global citizen. So the next time you see markets suddenly stabilize after days of fear, ask yourself what conversations might have happened that you didn't hear about. Because the most important signals are often the quiet ones. If you found this breakdown valuable, let me know in the comments. Do you think the dollar will remain dominant for the next 20 years? Or will China's currency strategy slowly reshape the balance of power? I really want to hear your perspective, and if you believe more people should understand how hidden financial diplomacy moves global wealth, share this video with someone who follows markets. Conversations like this deserve a wider audience. Thank you for watching The Monetary Shift. Stay curious, stay informed, and I'll see you in the next shift.